Okay, morning everyone, and welcome back. I hope you've had a good break and are all rested and ready to go. I have a couple of quick announcements. Firstly, welcome to the June guys. There's a couple of new people around from the June class. We will be doing a proper introduction to the June guys to the program. We'll do that on Friday after the lecture. Okay, so for those people, I will send out an email as well. There'll be an extra session for you after the Friday lecture. So Friday's audit, we'll do about an hour, maybe an hour and a half introduction to you guys to the program. Okay, results will be coming out throughout this week. So you'll start getting emails with the results, with all of your results. You can collect all of your scripts in one go on Friday. Okay, so as soon as we get to Friday, we'll let you know more detail and you can collect them then. Okay, if you want a remark of your script, remember the process that you have to do. You have to do that full post-mortem, go through your paper, highlight it, fill in that form, okay, and make sure that you've been through it and understand why there is or isn't a mark, and then you can submit it. Okay, so you'll have 2 weeks. So 2 weeks from Friday when you collect your scripts, to hand in those remarks for all subjects. Okay, I've covered all of that. If any of the June guys isn't registered, if you are registered but you don't have access to the LMS yet, please just drop Zani an email or come and see Zani. If anyone isn't registered yet, we'll do registrations at the end of the lecture. Okay, so at the end of the lecture, just come to the front here and we'll do those registrations. Any June guys as well that haven't had their fingerprints done, they can chat to Marnus at the back there and he'll do your fingerprints for you. Okay. Guys, any questions before we get started? Okay guys, I'm going to be doing IFRS 16, leases. But I've been saved. I'd like to introduce you to a new staff member that we have. Edwin, how do I say your surname, Edwin? Edwin Hove. Okay, he is, some of you might recognize him. He, in his previous life, was a lecturer at Edge Business School, and now he has come to join us. Okay, so welcome to Edwin. He'll be doing IFRS 16, not Gary. Yeah, I'm sure you are very relieved about that. Any questions before he takes over? Okay, guys.
No. Is it on now? Okay, cool. Okay, so let's start that again. Yeah, obviously it's on now. So my name is Edwin. Can see a few familiar faces and some very new faces. Just a brief background about myself. So I've been a lecturer for the past 5.5 years now, and got some experience in lecturing. So previously I was lecturing tax. So yes, a few people asked me, are you doing FINAC? Yes, I am lecturing FINAC in this environment, but previously I was a lecturer. But I'll still be assisting with the tax. So I will be assisting with the financial accounting and will be assisting with the tax. So I kind of do both. All right, so what gives me the credentials to be doing financial accounting? Before I actually started lecturing taxation, I was working at KPMG. I know, it's sad. It's really, really sad. I wish I did not say that, but I was working at KPMG in the technical department, and my job from morning till sunset, guys, was reading standards. So all I was doing for about 2.5 to 3 years was basically in a accounting department. So I do have some tax experience, but when I got the opportunity to lecture, and tax was the only available subject to lecture at the time, I did take tax. But yes, I do have a background in financial accounting. So I do know financial accounting, and I do know some tax. Is that cool, guys? All right. So I'll be looking at IFRS 16 today. Any questions before I actually start? Any questions? Anything you need to know? Okay, cool. All right, so let's look at IFRS 16. How many of you guys have done IFRS 16 before? Right, I think majority of you have looked at IFRS 16 before. All right, so let's look at IFRS 16. So I've given you some, let me look at the material that I've given you. I've given you actually one pack, and the pack that I've given you is this one here. Right, I think everyone has this pack of slides. So, sorry. I only got to find out on Tuesday that I'm lecturing IFRS 16, but it's fine. I still have good experience in lecturing. So what I usually do, the students that have actually encountered me in class, they know that I love writing summaries, okay? So I'm busy with my summary pack at the moment. My summary pack should be ready by the end of this week, but I will be using that summary pack as I'm going along, all right? So it's a summary pack where I basically put down all the important points for you to actually pass that standard or pass whatever it is that you're doing. So I have a summary pack that I'll be referring to. If I refer to the slide, you don't have it as yet, I will upload it by the end of this week. Is that cool? All right, so for most of you, you will be using that. Okay, so IFRS 16. Let's look at IFRS 16. Okay, so when you're looking at IFRS 16, IFRS 16 is the standard that basically deals with leases. We are accounting for leases, but what actually before I even start, why are you guys actually in this classroom? What's your end goal? What's your end game? Right? Why are you shy, guys? Most of you in this place want to be what? CA, SA, right? That's why you're here. CA, SA. But what's the point? If you're a CA, SA, why do you want to be a CA, SA? Think about it. Right? You want to put your John Hancock on something. Right? Either you review a set of financial statements, am I right? Or you're going to prepare a set of financial statements, or you're going to what? To prepare a set of financial statements. So review, audit, or prepare a set of financial statements. So the end game, guys, is a set of financial statements. Am I right? As an accountant, the end game is a set of financial statements. So when you're looking at a set of financial statements has 4 elements. What are the 4 elements that you'll find in a set of financial statements? Income statement, right? There will be an income statement. There will be a balance sheet, all right? I know I'm using the old terminology. Guys, I will catch up. So you will be looking at your statement of profit or loss, statement of financial positions, statement of cash flows, and you'll be looking at your disclosure statement. So those are the 4 main points that you'll be trying to prepare or review, or does that make sense? Okay, so the end game at the end of the day is those sets of financial statements. So guys, you as CAs will be looking at those financial statements. In looking at those financial statements, any well-written standard needs to be able to deal with your income statement, needs to be able to deal with your statement of financial position, your cash flows, and your disclosures. Does that make sense? So if you're looking at your IFRS 16 standard, your IFRS 16 standard, you will expect that your IFRS 16 standard deals with those 4 elements. Am I right? Okay. So let's look at that statement. So this is how I view it. Because at the end of the day, I will be reviewing a set of financial statements, preparing a set of financial statements, or auditing a set of financial statements. So at the end of the day, I need to make sure that this standard here deals with that adequately. Does that make sense? So this is how I view the standard. This standard is going to deal with a couple of things. Number one, what the standard is going to deal with is the objectives of the standard. What are the objectives of IFRS 16? That's the first thing that we're looking at. Does that make sense? So, looking at the objectives of the standard, and then looks at the scope of the standard. What is the scope of the standard? So if you're following through your slides, you will see that I'm now on slide number 2. Right? So, the framework of that standard. How does this standard work? Okay. So, objectives, number one, you need to make sure that we deal with the objectives, the scope of the standard, right? After looking at the scope of the standards, there's certain recognition exemptions that the standard deals with. After looking at those recognition exemptions that the standard deals with, then we start looking at this, the content, which is what is a lease, right? And then it goes into what a lease is, what a component is. It then goes into your leasee treatments and your lessor treatments, and then it closes off by dealing with your sale and lease back. All right, so now let's look at whether this standard is well written. Right, so let's look at the objectives of the standard. What are the objectives of IFRS 16? Okay, so the objectives of IFRS 16 deals with both a user and the preparer of that standard. User, preparer of the standard. So, as a CASA, right, as a CASA and as I'm reviewing the set of financial statements, what am I looking at? What are the 4 components that I'm looking at? I'm looking at the income statement, balance sheet, cash flow statement, and disclosures. Am I right? Okay, so therefore, you will see that when you're dealing with the objectives of the standard deals with those 4 principles. So, it deals with recognition, presentation, measurement, and disclosure, right? Recognition, measurement, presentation, and disclosure. And all these things happen where? Statement of your profit or loss, financial position, cash flows, and disclosures in the notes to your financial statements. Does that make sense? So therefore, this standard will deal with all those elements. Okay, so guys, you always need to take a step back when you're reviewing your financial statements. Is everything on that set of financial statements? Is that cool? Don't get lost in the detail. Take a step back and see, is everything in those 4 elements of the financial statement? So, from a user's perspective, a user will therefore be able to identify the impact or assess the impact of your leases on the financial statement, which is in the income statement, balance sheet, cash flow statement, and in your disclosures. And then when you're looking at your preparers of financial statements, this standard or the objective of the standard will help them to assess in any contract if there is a lease that needs to be recognized, measured, presented, and disclosed in the standard. Does that make sense? Okay, so looking at the objectives of the standard, the objectives do deal with the users of the financial statements, and they also do deal with the preparers of the financial statements. Okay, so after looking at objectives of the financial statements, now let's look at the scope of IFRS 16. Guys, comfortable? Have I lost anyone yet? Still with you? Okay. All right, so we've looked at the objective of the financial statements. Now let's look at the scope of this standard. So if you're looking at the scope of the standard, right, this standard here basically deals with all your leases. Obviously, right? It's a standard on leases. So you will expect that this standard deals with your leases. So this is a standard that basically deals with all of your leases. So it deals with your leases, and it also deals with something else which we call subleases. So you will have a lease and you will have a sublease that is also dealt with in the standard. However, right, there's certain leases that you're going to encounter, and those leases are specialized types of leases. And when you're dealing with those specialized types of leases, what happens with those specialized types of leases is these leases are therefore dealt with in other standards. All right, so therefore, if you're looking at the scope of the standard then excludes those leases that are dealt with in other standards. Does that make sense? So you will deal with leases in the standard, but specialized leases, so for example, your biological assets, your leases on biological assets, those leases on biological assets will not be dealt with in the standard. Make sense? Leases on. If you have a lease on in a mining environment, for example, IFRS 6 will be the better place to deal with those leases, right? So we've got exploration leases, biological assets, service concessions, leases that are intellectual property that are dealt with in IFRS 15, and you've got other leases which are intangible, which relate to intangible assets, and those are dealt with in IAS 38. All right, so the scope of the standard, all leases and subleases, except if there's another standard that deals with that type of lease. Makes sense? All right, so the scope of our standard is all leases and subleases. When you're looking at IAS 38 actually gives you a choice. You can either choose to use IFRS 16, or you can choose just to use IAS 38 for intangible assets. So when you're dealing with intangible assets, you have a choice to either go IFRS 16 or to go IAS 38. Is that cool? All right. So that is basically the scope of the standard. So what I've looked at the moment is I have looked at the objective of the standard, and now I have looked at the scope of this standard. So if you look at IFRS 16 and the reason why we have IFRS 16. So let's look at the reason why we have IFRS 16. So previously we had IAS what? 17, right? Okay. So previously we had IAS 17. And if you look at what IAS 17 did, IAS 17 basically says you've got an operating lease and you have a finance lease, am I right? So an operating lease, you will expense whatever expenditure that you incur on a lease, and then if you have a finance lease, then you'll recognize an asset, the underlying asset in your financial statements. Everyone comfortable with that? Okay, so the reason for IFRS 16 is basically you're looking at a standard that wants to look at one model. It wants to look at one model, not a dual model as before. And let's think about the reason for the one model. The reason for the one model is financial preparers or preparers of financial statements and entities that actually entered into these leases will manipulate the transactions in such a way that most of their leases will end up being operating leases, right? So what's the whole hoo-ha about having operating leases, right? You'll expense those payments on a straight line method, but if you think about it, these entities had entered into transactions where they were using an asset for a very long period of time, and in substance, it was like they own the asset. All right, so it's like you own the asset. If you own the asset, let's think about someone that owns the asset but physically pays for this asset. What happens in that person's financial statements? Someone that owns an asset and physically pays for this asset. What happens in their financial statements? What are the entries when you buy an asset? There's going to be a decrease in resources, makes sense, and there's going to be an increase in resources, right? Decrease in your bank balance, increase in an asset, right? What else happens if you have an asset? Depreciation. So therefore, your income statement is going to be affected. Is that cool? All right? So what does that have an impact on? It has an impact on the ratios in the business. So the ratios in the business are therefore now skewed. Can you see that? But on the other hand, if you had an operating lease, all you would present is what? An expense. Make sense? So therefore, the need for IFRS 16. So IFRS 16 brought a single model, which I will be looking at. However, right, IFRS 16 has what we call a simplified method. It's got a simplified method, and that simplified method is applied to two types of leases. One lease is called a short-term lease, and the other lease is what we call a low-value lease. All right, so I've looked at the objectives. Objectives is recognition, measurement, presentation, and disclosure. Guys, comfortable with that? I've looked at the scope, and the scope says all leases, right? However, if it's a short-term lease or a low-value lease, then we have what we call a recognition exemption. So if I were to give you an example is we have the use of a bus for a full month. We drive the bus to whatever part of the country that we want to drive the bus to, and then we return the bus at the end of this contract, right? So think about it. If you had concluded that this bus here is a lease, then you will have had to use the single model that I'm about to show you, right? And in using that single model, think about it. You've only used this asset for 1 month. Now you need to determine whether there's a lease in it. After determining whether there's a lease in it, then you have to account for it as a lease, but it's for only how many months? 1 month. Does it make sense? So you will see that there will be a recognition exemption when it comes to your short-term leases. So what's a short-term lease? Short-term lease is a lease with a period that is less than 12 months, less than or equal to 12 months. Guys, it's trying to alleviate the pressure of you recognizing this as using a single model. Does that make sense? So it's trying to make sure that you do not recognize this using the single model. So anything that's less than or equal to 12 months, that's not going to be recognized as using that one model. So short-term leases, less than or equal to 12 months. And we're looking at what we call the lease term here. So the lease term needs to be less than or equal to 12 months. If it's a 1 month lease, you do not need to go through the hassle of the single model. All right, the other lease is what we call a low value lease. Low value lease, a low value lease. So when the ISB was looking at the standard, there were certain assets that they felt it's not going to give lots of benefit if it's recognized using that single model. And that was assets that they envisaged to have a cost less than $5,000. Okay, so the two things that we're not going to recognize using the single model: short-term lease, low value lease. Short-term lease, less than $5,000 is what we're looking at, right? And when you're looking at this low value asset, let's think about it, right? You are a mining company. Your turnover in a year is, say, 20 billion, right? And you enter into a lease where furniture and equipment is brought into your business, right? Think about it. You pay your accountant well over 2 million rand a year, and you expect this accountant to then go through that contract and recognize your furniture and equipment using the single model. It's going to take a long time just to determine, right, the implications of that the accounting implications of that transaction, right? So therefore, your low value assets will be excluded from that single model. All right. So let me deal a bit more. Actually, before I deal with the implications of that single model, there are a couple of things that I want us to actually pick up with regards to just a second. A couple of things that I want us to pick up with regards to short-term leases and with regards to low-value leases. So let's look at your low-value leases. So your low-value lease, when can I classify or determine that this is now a low-value lease? Right? Low-value lease, I think I've already mentioned that I'm looking at something that's less than or equal to $5,000, right? The second thing that I can look at is, number one, can I use this asset on its own? Right? And is this asset dependent on another asset? If it's not dependent on another asset, then I can classify this as a low-value lease. So if I, to give you an example, right, a company buys all its employees' laptops or buys all its employees' tablets, right? Enters into a contract where they deliver tablets to the company. So in that case, right, let's think about the tablet. Can a tablet work on its own? Yes. Right? Does it need another asset to work with the tablet? No. Make sense? So therefore, in that example, then your tablet will be recognized as a low-value asset. So can we enjoy the benefits of the asset on its own? Can you use the tablet on its own? Yes. Right? Is it highly dependent on another asset? No. Right? An example where something is not going to be classified as a low-value asset, an example where it's not going to be classified as a low-value asset is if you have a server. Let's think about a server. Have you ever seen a server room? Okay. A server will have multiple computers that are connected to each other, right? So if you remove any one of those laptops, will the server work efficiently? No. So in that case, that laptop, even though on its own it might look like a low-value asset, but it's highly dependent on other assets. Does that make sense? Okay. So therefore, for an asset to be low-value asset, you need to be able to enjoy the benefits of the asset on its own, or if it's used with another asset, the other asset needs to be readily available and it's not highly dependent on other assets. Now, let's say a company enters into a contract, and in that contract, they deliver 50 old cars. So they deliver 50 old cars. Are the 50 old cars low value or not low value? So let's say the market value of those cars is 10,000 Rand. Right? So let's look at the assessment. Is it less than $5,000? Yes. Right? Can I use a car on its own? Yes. Is it dependent on any other assets? No. So is it a low-value asset? It does look like a low-value asset. Can you guys see that? It does look like a low-value asset. However, when you're doing this evaluation of an asset being a low-value asset, you always need to consider the asset when it is new. Your evaluation is an evaluation of a new asset. When a car is new, do you think a car will be low value or not low value? Not low value, right? So therefore, a car, whether new or second-hand, can never qualify as a low value asset, right? So the nature of a car basically means that a car can never be classified as a low value asset. So, low value assets, less than $5,000. I can use it on its own, right? It's not highly dependent on any other asset. I look at the new value of that asset. Now, let's look at a small company. Let's say your company just started trading last year, and the sales in your company are equal to 100,000 Rand. And you enter into a contract, not you buy, you enter into a contract where they deliver laptops to your business, right? The total value of the laptops in your business are 80,000 Rand, and the sales in your business are equal to 100,000 Rand. So let's look at this contract here. Is this contract material with regards to your sales? Yes, right? 80,000 Rands worth of laptops when your sales for that period are equal to how much? 100,000 Rand. Can you guys see that? Okay, so will these laptops still be classified low value or not low value? Will you classify them as low value or will you not classify them as low value? Right, let's go through the requirements. Less than $5,000, right? Probably less than $5,000. Each single laptop is less than $5,000, correct? Number two, can you use a laptop on its own? Can you use a laptop on its own? Yes. Is it highly dependent on any other asset? Yes or no? No, right? So, can you classify this laptop as low value? Yes or no? Most of you are looking at the fact that it's these laptops that I've entered, this contract that I've entered into has laptops to the value of 80,000 Rand. It does look material with regards to this contract here, but the whole classification of low value has no regard to the size of the company that is doing that evaluation. Whether it's a small company or a big company that's doing the evaluation of low value assets or not a low value assets, you're looking at what we call absolute value of that asset. What is the absolute value of the asset, right? If the absolute value of the asset is such that it is low value, you will classify the asset as being what? Low value. Are you guys comfortable with this? Okay. So, low value assets, short-term leases. These types of transactions will not be classified or will not be recognized and measured using the single model. All right, so this is how then in my mind I will summarize everything that I've just done. All right, so number one, I dealt with, okay, so this is me now producing my summary for myself. Number one, I dealt with the objectives of the standard. The objectives of the standard are, right, recognition, measurement, presentation, and what? Disclosure. That's what I've done so far, right? This standard deals with recognition, measurement, presentation, and disclosure of the standard, right? What is the scope of the standard? The scope of the standard basically is all leases and what? Subleases. All right? And it's going to exclude anything that has been dealt with in other standards. So other standards are IAS 41, which is your biological asset, IFRS 6, which is your assets that are in the mineral extraction. You have your IAS 38, which is your intangible assets, and you have your IFRIC 12, which is service concession contracts. Right? So objectives, recognition, measurement, presentation, and disclosure. Right? The scope of the assets, all leases and subleases. All right, and then the final thing is that I've looked at now is your exemptions. And your exemptions are going to be two exemptions. Exemption number one is a low value asset, and exemption number two is then going to be a short-term lease. Okay, so for my low value, I'm looking at a value that is less than what? $5,000. In my short-term lease, I'm looking at a period that is less than how many months? 12 months. Are you guys comfortable with this? Okay, so now I'm structuring my thoughts, all the thoughts that I've just given you, right? So, less than $5,000, I'm looking at what we call absolute value. So if I'm looking at absolute value, I do not have any consideration to materiality, right? Or the nature of the business. If it's a small business, a low value asset will be a low value asset. Make sense? If it is a big business, a low value asset will be a low value asset. Okay? And we also look at the nature of the asset, and we also look at the asset when it is what? New. Right? So these assets will not, therefore, be recognized, measured, and presented using the single model, but what we call a simplified model, and that simplified model basically says debit and expense, and you will credit the bank. Is that not simplified? If you've got a low value asset, just do that. Make sense? All right, so if you've got a low value asset, that's all that you're going to do. If you've got a short-term lease, that's all that you're going to do, right? When dealing with a short-term lease, I know I didn't go into too much detail with regards to a short-term lease because the whole point of a short-term lease is we're looking at this concept of the lease term. And I haven't gone into too much detail dealing with that concept of the lease term yet, right? So I'm going to deal with the concept of a lease term. Once you understand the concept of a lease term, then I'll come back and deal with these short-term leases. Is everyone getting where I'm going now? Guys, good or not good? Okay. So, we've looked at the objective of the standard. We've looked at the scope of the standard. We've looked at recognition exemptions of the standard, right? And we've looked at the recognition of the simplified method, which is debit, expense, credit, the bank, right? Here, we actually need to consider lease equalization. Do you guys remember lease equalization when you're dealing with operating leases? Okay, so let's go to that slide, which then deals with lease equalization. Right, so if you're looking at your lease equalization, right? I do not envisage that this will be an issue when you're dealing with which asset. I dealt with two types of assets, low value and short term. In which type of transaction will this not be an issue? Short term, right? Because it's less than or equal to how many months? 12 months. So it's going to be an issue when you're dealing with low value assets. Right? When you're dealing with low value assets and you've got lease payments in year 1 with 2,000 rands, lease payment in year 2 with 2,600 rands, and lease payments in year 3 with 3,850. What does the standard say? The standard says that you need to equalize your lease payments, right? And what type of method are we going to use to equalize those lease payments? Straight line. And the straight line method is basically an average calculation, 2,026 plus 3,850, all that divided by 3. So therefore, it's anticipated that in year number 1, your expense is therefore going to be 2,817 rand, debit expense, credit your bank, and credit a liability. We accrue for that 817 rand. All right? In the next year, debit expense 2,817, credit the bank 2,600. Can you see there's still a shortfall in that year, and we credit again in that year a liability, right? And then in the third year, when we pay actually less than that amount, no, actually it's more. When we pay more than that amount, which is 3,850, then we'll realize that liability, debit liability, 1,033, debit your expense, and credit the bank. Okay, so lease equalization therefore becomes a significant point, but it only is a significant point if you're dealing with low value assets. Do not see this being an issue when you're dealing with your short-term leases. Any questions so far? All right. So, number one, we've looked at the objective of the standard. Number two, we've looked at the scope of the standard. Number three, we have looked at the exemptions in the standard, and we've looked at your simplified approach, and that simplified approach is on your short-term leases and your low-value leases. All right, now that we have dealt with our short-term leases and our low-value leases, I think the most important thing now to deal with is, what is a lease? I think everyone wants to know, what then is a lease? What's a lease? Because the standard says you deal with all leases, right, and subleases. Okay? So now let's deal with what is a lease. What is a lease? So, if you're dealing with a lease, the standard basically says that you need to evaluate, or you need to assess to make sure that a contract includes a lease. Whenever you enter into a contract, you need to evaluate, does this contract that I've into contain a lease? Right? So therefore, your starting point is evaluation of what? Contract. Once you've entered into a contract, you need to first evaluate in this contract, does this contract contain a lease? Right? So let's define what a contract is. What is a contract? What is a contract? What are the key components of a contract? What makes a contract a contract? Right? You need parties to that contract, am I right? So you need counterparties to the contract. And the important thing is, in a contract, you're looking for what we call rights and what we call what? Obligations. A contract, right, that we need to be evaluating here needs to contain rights and obligations. And these rights and obligations, the very important thing about these rights and obligations is these rights and obligations need to be enforceable. Are these rights and obligations enforceable? Okay, so if you have enforceable rights and obligations, then we're in the right track. We're dealing with a contract. But if you're dealing with something that has been signed that does not have enforceable rights and obligations, then that is not a contract that we'll be assessing. So let me give you an example of a contract and something that you enter into that doesn't give you enforceable rights and obligations, where both the lessee and lessor can walk away from this transaction without any cost to it. So anyone can cancel the contract at any time without any costs that are incurred. Does that make sense? So if anyone can walk away from the contract without any costs that are incurred, then this is not an enforceable contract, and therefore we cannot assess it for a lease or no lease. Okay, so number one, we're looking for a contract with enforceable rights. So if it's got enforceable rights, then it's cool. We need to move on and consider if this contract contains a lease. So now we're going back to my question, what is a lease? So going back to my question, what is a lease? A lease conveys two things, three things actually, right? A lease, if I were to go to, let's go to the slides because you guys have got slides in front of you there. Okay, so a lease is a contract that contains, so I've already dealt with the contract side, everyone comfortable with that? A lease is a contract that contains or conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So that's what a lease is. So number one, identified asset. Did you guys see that in the definition? Identified asset that is controlled by an entity for a period of time for consideration. So when you're evaluating a contract, you're evaluating the contract for that. Number one, identified asset. Number two, is it controlled by the entity? Number three, for a period of time. Number four, for consideration. So let's deal with the period first. What is a period, right? A period can be a continuous period or it can be a broken period. Continuous, broken, right? It can be a continuous period where it says 3 years. It can be a broken period where you use it only for from January to March each year. Make sense? Continuous or broken period. The other thing about your period is we're looking at it can be a time period or it can be a quantity thing. Time, quantity, right? Number of months or number of units produced. Make sense? Time, quantity. Okay. Continuous period, broken period. Quantity, time. Guys comfortable with that? All right, for consideration. For consideration, obviously for in exchange for what? Monetary consideration. Right, I will deal with a point that deals with consideration just now. But let me look at identified assets. So it needs to be what we call an identified asset. So an identified asset in your contract can be explicit. The contract can say, we will give you the use of XYZ car. We will give you the use of XYZ building. Make sense? Explicit in the contract. Or the contract can be silent, and the contract, therefore, if it's silent, will be what? Implicit. Implied in the contract. Right? You can see that there is an underlying asset that has been conveyed. The right of use of that asset has been conveyed. So explicit, implicit, right? A very important thing about an asset is it needs to be physically distinct. Right? It needs to be physically distinct. Car, building, physically distinct. Am I right? Car, building, physically distinct. However, there are situations where capacity can be an asset. Capacity. Where capacity can be an asset. Right? So, you enter into a lease arrangement where you're renting out space. Right? Doesn't have a physical form, right? but it can be an identified acid, where you are using an oil pipe, right? So you're getting oil from Durban to Joburg, and you're using that entire pipe. Make sense? So that capacity of the pipe can be an identified acid. But the main thing is it needs to be a what? Identified acid. If it's not an identified acid, then it cannot be an if it doesn't have a physical distinction, then it cannot be an identified acid. It needs to have a physical distinction. So, either explicit or implicit, can be capacity, it can be physically distinct. But the main thing is, it's the customer that controls the acid. So, when you're identifying your acid, there are certain scenarios where this controlled or this identified acid technically is not in the control of the customer. If it's not in the control of the customer, then we're not in a lease situation. So this usually arises when we have what we call substantive substitution rights. Substantive substitution rights. Substantive substitution rights. So let's look at this concept of substantive substitution rights. Substantive substitution rights is you have the use of this car. At any time, the owner of the car can come and swap this car for another car. That's what we call substantive substitution rights. So if the owner of the vehicle can substitute that acid for another acid, do you have control over that acid? No, right? So substantial substitution rights arise when these two requirements are met. Number one, the owner of the company, of the acid, has practical ability to change that acid. They can swap the acid at any time. They've got that practical ability to swap that acid. Number one. And number two, right, is the economic cost exceeds the substitution cost. Right? So there's a car that's under a lease agreement. The owner delivers another car, gets the other car back. Right? If the substitution costs are less than the economic costs, then in that case, the supplier has substantive substitution rights. Substantive substitution rights. Okay, so practical ability and economic, it will be economical for the supplier. All right, don't worry, I'll look at a couple of examples just now. All right, so number one, when we're looking at evaluating the acid, number one, we said identified acid, which I've dealt with. We've dealt with the period. We've dealt with consideration. So now the only thing I need to deal with is control, right? So now I need to deal with control. When do we have control? So control arises when, number one, we have substantially all the economical benefits of the acid. Substantially all economical benefits of the acid, number one. And number two is we direct the how and for what. I control an acid. substantially all the economical benefits. Number one. Number two, if I direct the how and for what. So let's look at the economical benefits. Economical benefits are, if you have a manufacturing, simple, the products that you're manufacturing from that asset, right? If you have a car, right, it will be you controlling that car for that period of time. So it can be a product. It can be the use of that asset, you're benefiting from the use of that car, or you can be benefiting from preventing someone using an asset, preventing access to someone using that asset. All right? So when you're looking at economical benefits it's not just the product, it is the use, preventing someone from using the asset. It's quite a broad thing that is economical benefits. So you preventing someone to use an asset is or can be seen as an economical benefit. Okay, so number one, you need to be controlling all the economical benefits, and number two, you need to be controlling the how and for what. So economical benefits, products, and the use of the products. But when you're looking at these economical benefits, there are certain things that we can exclude. All right? So let's look at a situation where you have what we call protective rights. So you've entered into a lease agreement with someone and they give you their car. But one of their requirements is you can never drive this car in Soweto. Make sense? Can never drive the car in Soweto. Why is the lessor actually stating that? They are protecting their asset, right? So protection of assets, all that protective rights give about is the scope of use of an asset. It doesn't mean that you do not have the economic benefits. You have the economic benefits anywhere else in Joburg except for Soweto. Does that make sense? Okay. Right, so your protective rights basically deal with the scope and the use of that asset. All right, and then the final point that we'll look at is the how and for what before we get into a couple of examples. Right, the how and for what decision. The how and for what decision, we're basically looking for the most important how and what decision. That important decision of the how and for what. So you're looking at the most important decision. The most important decision will direct the flow of the economic benefits. So how and for what? So how and for what we're basically looking at. Can I control the decision of the mix of products that can be produced by this asset? Right? The mix of products, the type of product that I can produce, when I can produce, how I can produce. Are you guys getting this? Right? So that important decision of that affects the flow of your economic benefits. How? When? So that's the how and for what. So if you enter into a lease agreement that basically says you cannot drive a car in Soweto, right? But you can drive anywhere in the country, right? It basically means you can set the time when this asset will be used. I can use this asset from 1 a.m. to 6 p.m., right? I can use the car for 1 hour. I can prevent someone from using the car forever. Make sense? That will be an important decision, which is mix, type, when, how. So those are examples of your how and for what. There are some situations where this decision is predetermined. where the decision is predetermined, the how and for what. So let's look at an example of when this decision is predetermined. This decision can be predetermined in the fact that you enter into a contract, and the contract specifies when the product will be picked up, when the product will be delivered. Can you guys see that? This decision has already been predetermined in your what? Contract. How much quantity is going to be produced, where the quantity is going to be sold, right? So if it's a situation where it's a predetermined how and for what, you look at two things. Number one, who operates the asset? If the supplier operates the asset, then it basically means that the lessee is not controlling the how and for what, because everything is already predetermined and the supplier is doing all the operation of the assets, right? And then the other decision to consider is, does the buyer, or did the buyer design the requirements? Was he involved in the design of this asset? If the buyer was involved in the design of this asset, can you guys see that the buyer is in fact the one that did what? Predetermined the how and for what. All right, guys, I know a lot of theory that I've been blurting out. Okay, now, some strange reason it's not going to where I want it to go. So, what is a lease? We evaluate in the contract what a lease is, identify the asset, needs to be controlled during a period for a consideration. So, let's quickly go to an example. Oh, do you want a break? All right, guys, go for it. Let's make it a 5-minute break, 10-minute break. Ten minutes. Hi, good and you? How's it going?
Point form and really, really simplified.
Okay, cool.
Everything was nice.
Thank you so much. Yeah, it's been a while since I've done accounting, so.
Good. Candice told me that you were leaving Edge, and I still thought maybe Edwin will go back to
I,
audit firm or corporate.
nah, I'm not corporate.
And then we got an email saying we've got a new lecturer, Edwin. I didn't even have to read your last name. I was like, "Oh, exactly." So it's nice.
I actually was offered the contract in February, but I just didn't want to leave the guys hanging. So actually, when I saw you at Edge this one time, I almost told you that I was coming to IAS, but I was like, no, let me not tell you.
I did four SAPs, sincerely one, including tax, which I found that to be easy.
Yeah,
So
sure.
I was shocked because I came out of the exam saying, it's just so easy. I know I've done well, computer some tests was difficult. And then, yeah, four SAPs, and I just thought which ones are realistic in the past systems, and then I just thought,
Cool. Pleasure. How's it?
How's it going? You all
Good, man.
right? Awesome.
We'll get my groove.
It's English.
We'll get my groove soon.
Good, eh?
How's it going so far?
Good. Being able to sleep is very important. I got to this part is sleeping well. I'm not even joking. If I showed you what I was doing, I nearly got arrested. I drove in Rivonia so hammered. I got pulled over by cops. The cops literally flipping, it was the cops
I know.
When you started lecturing, it was 16, it was very funny. So you so used to text.
Text.
First time learning.
How's it going so far? Is it okay? Can you follow?
Good. Good. I haven't eaten.
Hey, how's it? Good, man. Good. I'm here. I'm here. No, good. You will tell me how it's going. Yeah, I used to do accounting.
How many you got eat?
No, it's cool. Yeah, I'll do tax and accounting. I don't know. We'll see. It's difficult. No, cool, man. It's good seeing you. All right, so before the break, guys, we're looking at what is a lease, right? So when you're looking at what a lease is, three things that need to be present. Number one, identified asset. Obviously, there's the period and consideration. Those are not that important, but the three critical components are: one, identified asset. Number two, the right to control that asset. And how do you control the asset? You control the asset by getting substantially all the economic benefits, and you control the asset by directing the how and you direct the how and for what. So that's what we're looking at before the break. So, looking at the how and for what, we actually gave a few examples. Can you change the type, mix, when, how much is produced, right? When you produce it, that's an example of when you control the how and for what, right? When you're looking at your economic benefits, you can use an asset, hold an asset, sublease an asset, prevent others from using the asset, and it basically will be your economic benefits. And then I also spoke about your protective rights, where you have a limitation that's imposed on the asset. Any limitation imposed on the asset only defines the scope of that asset. So it only defines the scope of using that asset, right? It doesn't mean that you do not control that asset, right? And then I also spoke about the asset itself, the underlying asset, explicit or implicit, and I also spoke about substantive substitution rights. Substantive substitution rights, where the owner of the asset has the practical ability to substitute an asset, and they will benefit from that substitution. Okay, when you're looking at substantive substitution rights, operating an asset is not an indicator that you do not control an asset. Okay, you can control other aspects of that asset. Okay, so when you're looking at practical ability, you will also exclude your substantive substitution rights when someone is repairing your asset. So they give you a replacement asset whilst they repair your asset. That's not substantive substitution rights. Okay, you also exclude any future events when you're evaluating substantive substitution rights. So exclude future events. You look at the asset now. Right? Economic benefits, substitution costs need to be less than the economic benefits for the supplier to have the economic benefit of that asset. All right, so let's look at an example. So if you go to your slides, I want us to look at this example here. All right, so a coffee company entered into a 3-year contract. Remember, for us to determine whether there's a lease, we need one, a contract which has enforceable rights. You guys remember that? Right, so we have a contract, and the contract is with an airport operator to use a space in the airport to sell its goods. All right, so let's look at that question again. Coffee company entered into a contract, so there is a contract with an airport operator to use an asset, a space in the airport to sell goods. The contract states the amount of space allocated to the coffee company, stipulates that the space may be located at any one of the several boarding areas. Right? The airport operator has the right to change the location of the space allocated to the coffee company at the time, and the airport operator incurs minimal costs in changing that space. So there are three things that we're looking at. Number one, identified asset. Is this an identified asset? So when you're looking at identified asset, it can be implicit or explicit in the contract, right? Implied in the contract or explicitly stated in that contract, right? Explicitly stated in the contract is what? Space. Right? Space is what? Capacity. Space is capacity. Is this space physically distinct? It's not. Space. They will allocate on the day. Right? So they will allocate at some time. Does that make sense? So this space here is not physically distinct. So we don't have an identified asset here. However, guys, not all the time when you're dealing with capacity that it's going to give the same answer. Capacity, where it results in an asset is, they say you have space on the first floor. Make sense? Then you have substantially all the economic benefits of the first floor. Does that make sense? But in this case, they just say space, and it's not physically distinct. Make sense? Okay. So, identified asset. It's not an identified asset. It's space, it's capacity. It's not physically distinct. All right, so that was item number one. Item number one, is there an identified asset? Okay, also looking at identified assets, substantive substitution rights. We can also look at substantive substitution rights. Substantive substitution rights, number one, when you're dealing with substantive substitution rights is, does the airport have the practical ability to substitute this space? Do they have the practical ability to substitute the space? The operator has the right to change the location of the what? Space. Can you guys see that? So therefore there is a practical ability to substitute the rights. Number two, when you're dealing with substantive substitution rights is it of economical benefit to the operator? Is it of an economic benefit? The airport operator incurs what? Minimal costs when they substitute that space. Does that make sense? So therefore, what it means here is that the operator has substantive substitution right, which means that the lessee does not have an identified asset. Remember, there are two parties to the contract, the lessor and the lessee. The lessee in this case does not have an identified asset. So if the lessee does not have an identified asset, there's no lease. Make sense? Okay. We can actually go further with this evaluation. Do the economical benefits flow to this person? When we're looking at economical benefits, what are we looking at? Let's look at economical benefits. If you're looking at your economical benefits, can these guys prevent someone else from using the asset? The counterparty to this transaction, can they prevent someone else from using this asset? No. The operator can tell them to move at any time. Does that make sense? So therefore, the lessee, or the person that's evaluating the lease, cannot prevent someone else from using that space. If they cannot prevent someone else from using that space, then they do not have any of the economic benefits of the space. Okay? So in this case, they explicitly said it's space, right? But the problem with that is it an identified asset? It's only an identified asset if it is physically distinct, if it's the entire first floor area. But it's not the entire first floor area. It's space that can move anywhere in this terminal. Okay, it's explicitly stated, but it's not physically distinct. All right, so economic benefits, you don't have any of the economic benefits, right? Do you have control over the how, why, where, right? You potentially do have the rights to do that, but unfortunately you will be moved from space to space. You do not have an identified asset. Okay, so let's look at the second example. Looking at the second example, King Pies enters into a 5-year contract with the owner of that shopping mall to utilize one of their shops. Again, guys, we're looking at those three things, right? Identified asset, economical benefits, and we're also looking at, do you have control over the how and for what decision? Okay, so let's look at whether there's an explicitly stated asset. Utilize one of their what? Shops. All right? During the period, the 5-year period, the property owner may require King Pies to relocate to another shop of similar quality, specifications to the original. Any relocation cost will be paid by the property owner. Okay, so for this to be explicit, right, in this example, we actually assume that it's explicit, but usually in a contract, they will say shop number 21, right? And then it will be it will be explicit. So we have an explicit asset that has been identified, which is a shop. Is it physically distinct? Can you point to the shop? Yes, it's physically distinct. This shop here is the shop that's in question, physically distinct. Now, we need to look at whether there are substantive substitution rights. Substantive substitution rights, number one, does the owner of the shopping complex have a practical ability to move this guy? Does he have a practical ability to move the guy? He potentially does have a practical ability because he says he may require him to relocate to another space. Guys, comfortable with that? Right? So, number one, practical ability, and is it economical for the owner of the complex? The contract requires King Pies to sell during certain hours, makes decisions. King Pies has physical access over the asset. Just looking for any relocation costs will be paid by the property owner. Do you think it will be economical for the property owner to relocate King Pies? Right? You potentially are in a situation where your economic benefits will be less than your what? Relocation costs. Think about it. The property owner has to remodel another shop into the specification of King Pies. Repaint, move all their stuff, do everything for King Pies. So in a situation like this, your economical benefits are less than your relocation costs. So therefore, the owner of the complex does not have substantive substitution rights. It's going to cost him a lot to move that shop. Okay? So if it's going to cost him a lot to move that shop, therefore what we have is an identified shop. So we've got an identified shop. Guys, comfortable with that? Okay? So we've got an identified shop. Now let's go and look at whether they have all the economic benefits. Right? So the contract requires them to sell goods during the hours. Guys, during the hours. You can only sell from 8 a.m. to 8 p.m. What is that? Protective rights. Do you guys get that? Those are protective rights. So if those are protective rights, it just defines the scope of your lease. Doesn't mean that there is no lease. Does that make sense? Okay. Just defines the scope of your lease. King Pies makes all the decisions about the use of the asset. So can we see here that we control the how and for what? Right? We determine the number of pies that we sell. We determine when we bake the pies. We determine everything about the pies. Does that make sense? So in this example here, King Pies determines the how and for what decision. So if they determine the how and for what decision, right, we also need to look at whether they got all the economic benefits for using that shop. So they determine that. King Pies controls physical access, so he can deny anyone using that asset. Can you guys see that? So therefore, in this situation here, we've got an identified asset. We've got substantially all the economic benefits because we can use the asset, we can prevent others from using the asset, and we can direct the use of that asset. So in this case, then this contract here does contain a lease. Okay, so your three things that you're looking out for are identified asset, the underlying asset, which is the shop. Is there any substantive substitution right that the lessor has? Do they have a practical ability over the asset? They do have a practical ability to change, but the only challenge they have is, will it be economical for them? Right? So substitution costs need to be insignificant. In our case, the substitution costs are what? Significant, because they have to pay all the relocation costs. So once you've determined that, you've got an asset, you need to look at the right to obtain substantially all the economic benefits. And what are the economic benefits? You can use, you can hold, you can prevent others from using the asset. Right? And then the right to direct the asset, the how and for what decision. Is everyone comfortable with that? Okay? So in this case, this contract does contain a lease. So this assessment we do at inception date. At inception date is when you have signed the contract. That's when you assess the contract. You determine, does it have a lease? Does it not have a lease? If it does have a lease, then we'll look at the accounting implications of that lease. All right, let's look at the next example. Next example, Entity X entered into a 15-year contract. So again, we do have a contract with the supplier for the right to use a specified amount of capacity within a cable. Guys, this again is a what? Capacity issue. Right? It's a capacity issue. Right? Capacity will only be an asset if it's physically distinct. Right? I'm using the entire cable. If I'm using the cable and information in that entire cable, then it's physically distinct. Right? If this guy has got a bunch of cables and my data just flows in any one of those cables, it's not physically distinct. Does that Okay, so contracted capacity is equivalent to what? 3 fiber strands. Now the question is, are those 3 fiber strands identifiable? Do I know it's these 3 fiber strands? No other information should flow that's not my information in those fiber strands. Does that make sense? So then we have to look at whether there's substantive substitution rights. Can the owner of the fibers interchange the use of those assets, right? Can he switch off cable 1 and put me through cable 3? Make sense? If they can do that, then they have a practical ability to substitute. Does that make sense? And number 2, we need to look at whether it is economical for them to do that. Is it economical for them to do that? They can substitute at an insignificant cost. Then they have a substantive substitution rights. I do not have a physical asset. Makes sense? Okay. Cable contains 15 fibers with similar capacities. The supplier oversees the cable usage. They determine which fibers are going to transmit. So can you see, right? I cannot physically see which of the 15 cables is my 3, right? And number 2, this guy here directs the what? How and for what? I will only direct the how and for what if I tell him when my data goes through, right? How much of the data goes through his cables, right? And if I can restrict other people from using those cables. In this case, can I restrict anyone from using those cables? No. So the economic benefits also do not lie with the lessee in this question. So there is potentially an identified asset only if we know the 3 strengths that direct our data. Does that make sense? So in this case, I cannot conclude that there is an identifiable asset, because this guy potentially has substantive substitution rights. They can practically interchange any of the 15 cables to be my cables. Right? Economic benefits, I cannot prevent others from using this asset, and I cannot prevent others from directing the use of the asset because they tell me what usage, how much data, when the data is flowing through the cables. Does this make sense, guys? Okay. All right, let's look at another example, right? The last example. So Mr. T entered into a 3-year contract. BMW to purchase a new silver BMW 120. The vehicle is specified in the contract. There are no restrictions in the contract on how he should use it. Mr. T is able to make all the decisions concerning the vehicle, including the decision to sell the asset. Right? BMW retains legal ownership of the vehicle up until the last payment is made, at which date ownership will be transferred to Mr. T. However, vehicles are normally traded in for newer models after 3 years. Identified asset. Identified asset? BMW, there, right? Substantive substitution rights. Can the lessor in this question substitute this vehicle for another vehicle? No. Practical ability? No. Right? Does he have all the economic benefits? Yes. He's got all the economic benefits. Can he prevent others from using this asset? Yes. He can make whatever decisions. Right? Can he direct the use? Contract says there's no restrictions. He can drive it into a ditch. He can do whatever he wants with the vehicle. Right? Now, let's look at this contract here. Does this sound like a lease, though? Do you have control over the use of the asset, or do you have control over the asset itself? The asset itself, right? A lease, for it to be a lease, you need to have control over the underlying asset, right? So here we go. We're looking at controlling the underlying asset. But the underlying asset is not your asset. It needs to be controlled for a period of time. This guy can sell this asset at any time. Right? So he controls this entire asset from day one, right? And not just the use of the asset. He controls the entire asset itself. So if he controls the entire asset itself, this transaction is not going to be under IFRS 16. It's going to be a normal sale transaction. So you need to consider certain transactions that those transactions will be normal sales transactions. Here we're looking at the underlying asset and the use of that underlying asset only. Okay, guys, comfortable that we can now identify a lease. Identify a lease if there is an identified asset. If you control that asset, how do you control the asset? Economic benefits. And the how and for what. Okay, so once we've concluded that we've got a lease, next thing that we need to look at is components of the lease. Because you can enter into a contract and the contract will have an underlying asset, another underlying asset, maybe services, and maybe administration. Right? So what IFRS 16 says is, once you have identified that the contract contains a lease, yep. Okay, so in that other transaction is a pure finance transaction. It's not an ownership transaction, it's a finance transaction. They're just giving you finance to buy the vehicle. But you can make any decision that you can over that vehicle. You can sell it as long as you settle your liability. Yeah. Just like most of our vehicles. They just financed you to buy that vehicle. All right, it's not a lease transaction. Okay, so identifiable asset, economic benefits, the how and for what. Okay, so now you've determined that this contract contains a lease. Now you need to separate the components of that lease. So you can have a contract which has multiple transactions or multiple assets, underlying assets, and other things. What you need to then do is to separate this into its individual components. So therefore, you will have underlying asset number 1, underlying asset number 2, right? And you will have these two components here, which are what we call non-lease components. So you will have your lease components of that contract, and you will have your non-lease components of the contract. So if you're a lessee, right, you have a policy choice. You can do this. Separate your underlying transactions, or you can opt for what we call the practical expedient. The practical expedient is basically where you lump everything into one contract. Okay, instead of breaking it down into those multiple underlying transactions, it's lumped into one contract. So practical expedient is one way you can go about it, right? But that's only for a lessee. A lessee will have that policy choice. Okay. However, when you're dealing with a lessor does not have a policy choice. A lessor has to break down the transactions into their individual components, and that's because they need to use the principles from IFRS 15, where basically you need to break down the contract into those individual components. All right? So if you have identified components, allocate your consideration to those components. If you're a lessee, that's a policy choice. If you're a lessor, there's no policy choice. You have to allocate. All right, so after you've determined your components, then we look at the lease term. Lease term is a very, very important thing. Okay, because your lease term is going to then be instrumental to your calculation of, so when you're calculating your lease liability, you need to have a lease term. So your lease term, let's look at what a lease term is. Your lease term comprises of two components, right? Let's look at those two components. So if you're looking at your lease term, comprises of two components, and those two components are, component number one is what we call your non-cancelable period. Non-cancelable period. Component number two is any option that you have to extend or any option that you have to terminate the contract. So it's a non-cancelable period and your option to extend. So if you're looking at your option to extend, your option to extend has to be reasonably certain. If it's not reasonably certain that you'll extend, then you're not going to include that into your lease term. So therefore, your lease term will exclude that portion, right? If it's reasonably certain. When is it reasonably certain? It's reasonably certain if you've got an economic incentive to extend that contract, right? So let's look at an economic incentive to extend a contract. What's an economic incentive to extend a contract? Let's say you lease a specialized asset. There's only one manufacturer of this asset in the entire country, and you have this asset. Imagine if you cancel the lease, what do you need to incur to replace the asset? You need to go and find another supplier. You need to go and find another asset. You need to replace this asset. Does that make sense? So it's an economic incentive for you to extend the contract because it might cost you a bit more to actually find another type of asset. All right. So lease term, non-cancelable period is what we're looking at. So you're looking at your option to extend. Only if you're reasonably certain that you will extend that option, then it will be included into your lease term. It's not included in your lease term if you're not reasonably certain to extend. Now, the consequences of this are important, right? Because if you have said you're not extending the contract, then you're going to present value your minimum lease payments over that lease term. So if it's a shorter lease term, right, and then at a later stage you then change that lease term, it means that there's going to be a change in your estimates. And everyone knows that if there's a change in estimates, more disclosure requirements. Okay, so therefore, when you're looking at it, you need to consider whether it's reasonably certain that you're going to extend. All right, so now that we've looked at the lease term, let's now look at the accounting for your lessee. What are the accounting implications for the lessee? Let's look at the accounting requirements for the lessee. Accounting requirements for the lessee on day number 1. And what is day number 1? Day number 1 is at commencement date. At commencement date, this is what you're going to do. Debit what we call a right of use asset, and you're going to credit a lease liability. So again, remember I said it's a single model now. So if it's a single model, both your finance and operating is gone, it's been done away with. You now just have to say debit right of use asset, credit your lease liability. This happens at commencement date. And what is commencement date? Commencement date is when this asset is available for use. So, just to take it a step back, at inception, you assess if it contains a lease. Okay? So inception is the day when you sign that contract. Does that make sense? Inception is when you sign the contract. That's when you determine whether it contains a lease. And only at commencement date are you going to recognize debit right of use asset, credit your lease liability. All right? So in substance, basically what it means is if you control the use of that underlying asset, you have a asset that you need to recognize in your financial statements. So it was the view of the board at one stage that they would love to see what we call off-balance sheet transactions now being reflected in the balance sheet. So technically, in substance, you have the right of use of that underlying asset. Hence, it will be recognized in the financial statement. So debit right of use asset, credit your lease liability. So let's look at what then goes into your right of use asset. A couple of things are going to go into that right of use asset. Right, so number one, what goes into your right of use asset, right, is your lease liability, which is technically cost. That's the cost of your asset. The lease liability is going to be included into that right of use asset, plus what we call initial direct cost. So initial direct costs are then going to be included into the cost of this asset. Initial direct costs are what we call incremental costs that are included into the cost of this asset. Incremental cost, what do I mean by incremental cost? It's only the costs that arise from you entering into this contract, right? If you did not enter into the contract, you will not incur those costs, right? So you will find a couple of exclusions here, right? An exclusion here will be salaries. Whether you enter into a contract or do not enter into a contract, salaries will be paid. Make sense? So it's only incremental costs that will be included here. So if you use an internal legal department to enter into this contract, you will not include that as an initial direct cost. Right? However, if you get legal counsel from outside your office and that legal counsel is advising you on the contract, then in that case, that's an incremental cost that's included into the cost of this asset. Cool. All right, so lease liability. Initial direct costs included into the cost of your asset, plus any prepaid amounts. All right, so if you pay a deposit, for example, deposit will be included into the cost of your asset. Okay, so plus any deposits will be included into the cost of your asset. Less any incentives. If an incentive is an amount that is paid by the lessor to the lessee. So that's removed from the cost of your asset. So your lease liability, initial direct costs, prepaid amounts, and less any incentives will give us the cost of our asset. So these are the costs of our assets in your slides. The lease liability, initial direct costs, dismantling costs. If you will have to dismantle this asset, any dismantling costs will be also included into the cost of the asset, less any incentives paid by the lessor. So your journal entries again will be debit right of use asset. So I've already dealt with the liability side of things. Credit. Okay, actually in the liability side of things, there's something that I left out here. Debit right of use asset, debit what else? VAT. Okay, VAT, very important that you take into account value added tax. Okay, so if I'm looking at my initial direct cost, usually if it's an initial direct cost, I'll potentially credit the bank. Or if I have paid as a through credit, then credit a creditor. Okay? Again, you need to be cognizant of if there is a VAT element. Okay. So, debit right of use asset, debit VAT, credit bank, credit creditor. So that's my initial direct costs, right? Any prepaid amounts. So when you're looking at your prepaid amounts, the transaction date is commencement date. So before commencement date, if you pay a deposit, that deposit is going to sit in an accrual account, right? And when the contract commences, then you will release that accrual into your right of use asset. Okay, so any deposits will also increase that right of use asset. Guys, if it's sitting in an accrual account, the VAT element is already taken into account when you make the payment. Remember, VAT is taken into account at the earlier of payment or invoice. Right, so again, it will be debit right of use asset and credit whatever accrual account that you will have parked the prepayments in. All right, and then your lease incentives will be the last amounts. Actually, before the lease incentives, debit right of use asset, credit, a provision, and that provision is determined in terms of eryIAS 37. So if you have to dismantle, any dismantling costs will be taken into account in terms of eryIAS 37. All right, so these are the general entries that you're therefore going to apply when you recognize your asset. Any questions? Recognition, journal entries. Those are your recognition general entries. Right? And subsequent recognition, you've got an asset. What are you going to do with the asset? Depreciate the asset. I think everyone is awake for that. So so we're going to depreciate the asset. And how do we depreciate the asset? So let's look at how we depreciate the asset. We depreciate the asset by looking at two things. Number one, are you reasonably certain that you're going to exercise the option to buy this asset? If you're going to buy the asset at the end of the lease, then you're going to depreciate the asset over the useful life of the entire asset, of the asset. All right? If you're not going to purchase this asset at the end of the lease, then you're going to depreciate over the lower of the lease term or the useful life of the asset. Will you buy the asset? If you buy the asset, depreciate over the life of the asset. If you don't buy the asset, you depreciate over the lower of the term or the term or the useful life of that asset. All right, and that entry for your depreciation, guys, is going to be what? Debit the depreciation expense and credit your accumulated depreciation. Please do not forget, any asset that you hold, you're also going to do what? What are you going to do with the asset that you hold? Other than depreciate? Impairments, right? You always check your assets for impairments, so you're going to use eryIAS 38 to check that asset for impairments. So everyone comfortable with the right of use asset? All good? Okay. So, do you guys want a break? So let's make it 5-minute break. And then after the break, I will then look at the liability, and then I'll start looking at the lessor implications. Guys, what I usually do when I lecture, day 1, I kill you with theory. Day 2, then I'm going to do a lot of questions. Guys, why I do that is you will see everything coming together on day 2 when you're now starting to apply those examples. So cool.
Do you mind putting back that slide with the journals? I didn't get to finish. I think it's the one you were writing. Yeah.
Even better.
My head is spinning. Information overload. Thanks.
Okay, guys, let's start. Okay, so let's quickly recap what we've done. All right, so we've looked at the objective of the standard. All right, so objective of the standard: recognition, measurement, presentation, disclosure. All right, we've looked at the scope of the standard. The scope of the standard is any lease and any sublease. All right, and then there's certain things that are excluded from the standard, and those things are, those leases are, included in other standards. So, for example, IAS 41 biological assets will be excluded from this standard. All right, and then we looked at what we call recognition exemption, and the recognition exemption that we looked at to short-term lease, and we looked at your low-value assets. Okay, and then for these ones, we said we're going to use the simplified approach where we basically debit the expense and we credit the bank. All right, don't forget you can equalize these payments. Guys, comfortable with that? All right, and then thereafter, we then looked at what is a lease. So, what is a lease? A lease, for something to be a lease, there are 5 things that we needed to look at. Number 1, is it an identifiable asset? Right? Is it an identifiable asset? Okay, so that was the first thing that we looked at, where we looked at substantive substitution right. Do you guys remember that? Substantive substitution right. After we looked at substantive substitution right, identifiable asset, capacity, non-capacity. Do you guys remember that discussion that we had there? We looked at economic benefits. Economic benefits, can we prevent someone from using the asset? Can we use the asset? And so forth, right? How and for what was the next thing that we looked at. The how and for what. You can determine the mix of the mix of the economic benefits, when, how the asset is used, etc. Right? And it needs to be for a period. You guys remember it needed to be for a period, and when you're looking at a period could be a continuous period or it could have been a broken period. Okay, and the last thing, so it was period and for consideration. For consideration, we need to have an identifiable asset where we have economic benefits, which we control the how and for what, for a period in exchange for consideration. Right? Consideration will be payments that we make for using that underlying asset. Right? Please do not forget, you need to exclude an outright purchase. An outright purchase, right, is not going to be included here. You just recognize your asset. Debit the car, right, and credit a finance obligation. Okay, so here we're only looking at where you've been given the right to the underlying asset, not the asset itself. All right, after you've determined this, that you've got a lease, then you need to look at whether you're going to break it down into the separate components. Let's break it down into those separate components. Are you guys following what I'm saying here? Break it down into those components, right? If you've got multiple components, then you allocate your consideration to those multiple components. The only exclusion here is where you follow the practical expedient. The practical expedient is you basically look at that whole transaction as one transaction. Cool. So after we've broken it down into its separate components, then we're going to look at the lease term. The lease term, we say it was the period that cannot be cancelled, the uncancelable period, plus any period that is reasonably certain will be extended, or reasonably certain that it's going to be terminated. Make sense? That was our lease term. After we've determined our lease term, then we basically have the ingredients to then recognize your right of use asset and your liability. Right? So once you've determined all those above, then you're going to say debit your right of use asset. You're going to say credit your liability. So the right of use asset is what you're going to recognize initially, and you recognize this at commencement date. Cool? Right, so debit your right of use asset, credit your liability. I will deal with this liability. The other things that you include here were your initial direct costs. So if you have an underlying asset that you have a right of use to, and you need to mount it onto something, right? It's a manufacturing asset that you need to mount so that it doesn't vibrate, then those mounting costs will be capitalized as your initial direct cost, right? So plus IDC, plus any dismantling costs, right, less any incentives. And that basically gave us the initial recognition. Okay, so I've got my summaries, and in my summaries I basically then show you those journal entries at on recognition date. Those are the journal entries that you're going to post. Debit the right of use asset, and please do not forget the VAT element of it. Credit your lease liability, right of use asset, and any prepayments, prepaid expenses, for example, a deposit that is paid, right? Debit right of use asset, credit any provisions that are paid. All right, and then subsequent to this, subsequent measurement, when you're looking at your subsequent measurement, we said depreciation, the asset has to be depreciated, and you also need to remember to take into account any impairments. Okay, so that was your subsequent measurement. Actually, before I even go here, I think I just jumped the gun there. Subsequent measurement, you actually have 3 options that you can follow. And the option that I've just told you now is the cost model. Right? So the cost model is the more common model that you can use for your subsequent measurement. And that's depreciating your asset and taking into account any impairments. Right? Subsequently, you can also choose to use the fair value method. You can use the fair value method in terms of IAS 40, and that fair value method is if you have what we call investment property. So if that underlying asset is an investment property, then you can then go and use the fair value method. Okay? Or you can use the revaluation model. And that revaluation model you will use in terms of IAS 16 only if your underlying asset is of the same class as the revaluation model that you use in terms of IAS 16. Is that cool? All right, so that's basically what we have looked at so far. Any questions? Are you guys seeing where we're coming from and where we're going? Okay, I know it's a lot of theory for day number 1, but guys, trust me, on the second day it will be a bit easier. All right, so now let's look at the liability. Remember I said debit an asset, credit your liability. So now let's look at this liability. So if you go to your notes, the ones that I gave you, you will see how we then look at that liability. So an important thing about this liability is it's the present value of what we call minimum lease payments. Present value of minimum lease payments. So what are minimum lease payments? Those are the payments that will be made in the future, right, in your lease term. So that's why we had to look at the lease term. Can you see that? Because we needed to determine the lease term, and that lease term determines the present value. So we look at only the payments in that lease term. So let's look at an example of a contract. So looking at this example of the contract, we've got a non-cancelable period of 2 years, where we've got lease payments of 500 Rand per year, beginning of the year, right? And then we've got an option to terminate, and we need to pay a penalty of 300 Rand on termination. Right, at the end of the contract, we have one of two options. Option number one is we can purchase the underlying asset for 5,000 Rand, or option number two is we can return the asset. However, we've guaranteed the lessor, as the lessee, we've guaranteed the lessor that that the asset will be returned and it will have a value of 5,000 Rand. Okay, so let's look at what a guarantee is. So a guarantee basically is an amount that the lessee or another third party guarantees the lessor, the owner of the property or of the asset, the asset will be worth. So we are saying that at the end of the lease, this asset is worth 5,000 Rand. So in simple terms, we're guaranteeing that the asset will be worth 5,000 Rand. So if we return the asset to the lessor, right, at the end of the year, if the residual value is 3,500 and we've guaranteed 5,000, we therefore need to pay in an additional amount of how much? 1,500, because we've guaranteed the value to be 5,000 Rand. Right? If we buy the asset, we buy it for the guaranteed value, and that guaranteed value is 5,000 Rand. Okay, so if we are to look at this example we say it's a 2-year contract. At the end of the contract, we will terminate. So what is the cost of termination? Cost of termination, 300 Rand. We've also guaranteed that the asset will be worth how much? 5,000, but we know that the residual value is 3.5, so we need to pay in how much? 1,500. So you will see that this contract will have a cash outflow of 500 Rand in year number 1 and a cash outflow from our perspective of 1,800. So if we present value the future lease payments, if you present value those future lease payments, that will give us the liability on day number 1. So we present value that amount of 500 year 1, year 2 1,800, and that gives us our liability. So our liability is basically dependent on our lease term, right? So if we extend the contract, so it's a 2-year non-cancelable period, but we say reasonably expected to extend the contract. When will we extend the contract? We'll extend the contract if we have an economic incentive. Do you remember I say that? If we have an economic incentive, we will extend the contract, right? So let's say we determine at commencement that we will extend the contract. When we extend the contract, then we will include year number 3 cash flows, right? And then your year number 3 cash flows will be present valued, and once you present value those, you will determine your lease liability on day number 1 or on commencement date. Okay, so on commencement date, therefore, your journal entry will be debit, right of use asset, credit, liability. So what then goes into my liability payments, right? What goes into my liability payments is any fixed payments. Remember the 500 Rand that we pay per year? That's a fixed payment that goes into my liability calculation, right? Any guaranteed residual values goes into your lease liability. Remember the 1,500 additional amount I had to pay because I had guaranteed the asset for how much? 5,000 Rand. So that amount also goes into your calculation, right? Any exercise price, right? So for example, if we did not pay the return the asset, and we bought the asset for 5,000 rand, that 5,000 rand will have been included in the price of our liability. And then any termination penalties are also included into the calculations that go into your lease liability. And then the final amount that goes in there is any variable lease payments. So any variable lease payments also go into your calculation of your liability. Again, you look at your amounts that you're going to pay over the period of the contract, then you're going to discount those amounts to present value at commencement date. Okay, so what variable lease payments are we looking at here? The variable lease payments that we're looking at here are only the ones that are linked to an index, right? So only the ones that are linked to an index. Any variable payment that is not linked to an index is not included in our lease liability calculation, right? These amounts that are not linked to an index will be expensed in the period that they are incurred. So any variable payment subsequently, right, that you make that is not linked to an index, your journal entry for that will be debit a lease expense, credit the bank. It does not go into the value of your liability. Right, so my lease payments will include fixed payments, residual value guarantees, exercise price, termination price, and my variable lease payments. All right, so I've looked at the payments that you're going to pay in the future, yes. All right, okay, so you've gone ahead of me, walking and flying, but it's all good. I will look at what your in substance. All right, so your in substance fixed payments. So an in substance fixed payment, an example will be, you're given two options. Option number one is pay a monthly amount, or option number two, pay an annual amount. It might look like it's variable, right? But in essence, you just have one thing that's going to happen. It's either you're going to pay a what? Monthly amount, or you're going to pay a what? Annual amount. So there is a guaranteed outcome, but it's just fixed in a way that it looks like it's variable, but it's not variable. In substance is variable. Sorry, in substance is fixed, sorry. Makes sense? Okay, so an in substance fixed amount is an amount that it will happen, but it's just structured as if it's not going to happen. Okay, so why is it important that your in substance fixed payments are determined? Because your in substance fixed payments will be included fixed payments, and that are going to be present valued. Remember what we said about variable payments that are not linked to an index? Those are expensed. Okay, so that's why you need to determine that. Okay, cool. All right, so fixed payments go into the calculation, residual value goes in, exercise price goes in, termination penalties goes in, variable amounts goes in. So you look at the amounts that have not yet been paid. Okay, so any amounts that have been paid, you're not going to include in the calculation. Any amounts that will be paid are the ones that you're going to take into account. Then you're going to discount those amounts using your implicit interest rate. So your implicit interest rate is that interest rate that is going to do this, right? It's going to equate the present value of all your payments, guaranteed and unguaranteed, to equal to the fair value of your asset plus any initial direct costs. So it's going to present value any of your unpaid amounts, present values all those, and it equates those payments to the fair value of your asset plus any initial direct cost. So if I were to summarize that for you, right? So fair value plus initial direct cost equaling to the present value of all future payments, whether they're guaranteed payments or unguaranteed payments. So this is what your implicit interest rate does. Interest rate. All right, so implicit interest rate is the first choice that we're looking for, but if you do not have an implicit interest rate, remember this implicit interest rate is from the lessor's perspective. You can only determine it from the lessor's perspective because the lessor is the one that has actually got the asset itself, right? He knows the fair value of the asset and he knows what initial direct cost he has incurred to get that asset, right? If you do not have the implicit interest rate, then you can use what we call an incremental borrowing rate. Your incremental borrowing rate is the rate from the lessee's perspective. If the lessee were to go and buy an asset similar to the one in the lease, how much interest will that lessee be charged? And that's your incremental borrowing rate. So if I look at an example 2, on the 15th of December, A Limited entered into a 10-year lease of a floor of a building, right? So let's look at whether this is an identifiable asset. It's capacity, right? Can you guys see that? It's capacity, but this capacity is the entire floor of a building, all right? So therefore, it's identifiable. So it's an identifiable asset, right, with an option to extend for an additional 5 years. So the initial period is 10 years. Option is to extend for another 5 years. The floor of the building was made available, so that then will be your commencement date. When it's made available on the 1st of January. On commencement date, then we need to debit a right of use asset, credit a liability. Okay, the lease payments are 50,000 Rand per term, right? So during the initial term and 55,000 Rand for the optional period. So we've got the original term and then we've got the optional term. Remember what we need to do. Number one, we need to identify if there's a lease in the contract. There is an identifiable asset, so there is a lease in the contract. Number two, we need to identify the lease term. The lease term is the period that is not cancelable, right? Plus any periods that are going to be extended, right? The lease payment was for 50,000 Rand, initial 55,000 Rand for the optional period. At commencement date, A Limited was not reasonably certain they will exercise. So what's my term? 10. Guys got it, all right? So my term is equal to 10 there. All right, so now that I've determined my term, now I need to determine recognition. Initial recognition, debit the right of use asset. What goes into my right of use asset? What are the things that are included in the right of use asset? Included in the right of use asset, lease liability plus initial direct cost plus any prepayments plus any dismantling costs. Guys got that? Right? So now let's go back to the question and let's look at what's included there. Right? Was made available on the 1st of January. Lease payments are 50,000 Rand per year during the initial term and 55,000 Rand optional. So this amount is going to help me determine my liability. I need to determine my liability. Right? My liability is therefore going to be 50,000 Rand over 10 years. Now I want to see when this contract is being settled. All payable at the beginning of each year. So, beginning of each year, which means that I have a prepayment on day number 1. Right? I've got a prepayment on day number 1, so therefore I need to say debit my right of use asset and credit a prepayment. Does that make sense? All right, so therefore the first element of my asset is going to be that prepayment of 50,000 Rand. Does that make sense? Okay, and then let's look at the second element. Right, they incurred initial direct cost. You guys remember what we said about initial direct cost? Initial direct costs are also included into the cost of your asset. So therefore, I will expect that I'm going to say debit and a right of use asset by 20,000 Rand and credit the bank for that amount. Guys, comfortable with that? All right, of which 15,000 Rand was a payment to a former tenant occupying that space, which was 5,000 Rand. Real estate agent arranged, actually, as a lease incentive, the lessor agreed to reimburse that 5,000 Rand. Remember what we said? Initial direct costs less what? Any lease incentives. So therefore, the second element of that asset will therefore be equal to how much? 15,000 Rand. So I've dealt with the initial direct cost, I've dealt with the lease incentive, and I have dealt with any lease payments before commencement date. So therefore, the only amount that I haven't dealt with is what? The liability. So now let's deal with that liability. All right, so looking at that liability, the liability is going to be calculated as follows. Let's look at how we're going to calculate that liability. Right, I'm going to look at all my payments, fixed payments, variable payments that are linked to an index, right? Any amounts that I'm going to pay upon termination, make sense? I'm going to then present value all those amounts, okay? So going back to the question, what has been given? Is there any amount that I'll pay at the end of the contract? Nothing that I'm going to pay at the end of the contract, so therefore, it's going to be a straightforward calculation, and that calculation is I will have 9 lease payments of 50,000 Rands, right? Because my lease term is 10 years. I've already paid payment number 1 on the first day, so therefore there are 9 fixed payments that I need to present value using my implicit interest rate. Make sense? Okay? So therefore, I will discount 50,000 over a term of 9 years. Remember, it's beginning of the year, right? And that will give me my liability. But now, what interest rate did I use? Guys, comfortable with the lease liability payments? All right? Now, what interest rate did I use? Interest rate implicit is not readily determinable. So therefore, they use the what? Incremental borrowing rate. What did I say? Implicit interest rate is always our first choice. However, if we've got an incremental borrowing rate, then that's the rate that we're going to use. So therefore, going back to our calculation, you will see that we take 50,000 Rand over the term of 10 years. We present value that at an interest rate of 5%, and that will give us 355, 391. And that, therefore, gives me the right of use asset. Are you guys comfortable with that? Do you guys see how we got that right of use asset? Okay, so at commencement date, debit, right of use asset, credit your liability, credit your IDC, credit bank, right, with all these transactions here. Okay, so we therefore now have a cost of an asset which is equal to 420,391. So on initial recognition, that's what happens. And subsequent to recognition, what is going to happen? We're going to choose one of 3 options. Option number 1, cost, fair value, or revaluation model, right? And we're always going to use cost unless stated otherwise. So in this case, we're going to divide that by the lease term, right? And the lease term is 10 years. So 420 divide that by 423.91 divide that by 10. We therefore will have depreciation of 42,000 Rand and credit accumulated depreciation of how much? 42,000 Rand. Does this make sense, guys? So initial recognition, debit the asset. Subsequently, debit depreciation, credit accumulated depreciation. Cool. Is this making sense, guys? Okay. All right, so subsequent to that, any variable payments that are not linked to an index, those you're going to expense immediately when they have been paid. All right, and then the last thing that I'm going to look at is what we call a reassessment of your lease liability. I actually can see that I didn't get to classification of lessors, right? So it's okay, I'll deal with that in the next class. All right, so now let's look at reassessment of your liability. Okay, deferred tax I'll also deal with in the next class. All right, let's look at the next example after the deferred tax has been taken into account. Guys, those are your general entries: debit asset, credit liability, credit back, debit depreciation. All right, and then the only thing that I just did not deal with is the subsequent treatment of your liability. Subsequently, your liability is going to be increased and decreased by the following. Right? Your liability is going to be increased by your interest expense and decreased by your lease payments. So you will accrue for the interest, and then when you pay, you will reduce that amount. Okay, so now let's look at what then happens when there's a change to your lease term. So when there's a change to your lease term, certain things are going to happen, right? So, number one, when do you do a reassessment of the term? You will do a reassessment of the term if there's a significant change that has happened. Significant change will therefore prompt you to reassess your useful life. What's a significant change? Significant change is, for example, let's say you're 5 years into your contract and you incur a significant amount of leasehold improvements. You improve the property that you're in, right? If you think about it, you improve the property that you're in. Do you think that you're still going to cancel the contract at the end of the lease? What are you now going to do? Renegotiate for a longer period. Or if you've got a specialized asset, right, you will try and renegotiate for a longer term. So what happens if you're now changing the term that you initially had, right? So if you change the lease term, or if you now reasonably certain that you're going to exercise an option, or, right, there's any future variable payments that are linked to a floating interest rate that are made during that year, what you're therefore going to do is reassess your liability, and by reassessing your liability, you might increase the liability itself or decrease the liability. And in the other leg of that general entry will be to the right of use of the asset. Let me look at this example here. So in this example, A Limited's workforce doubled in size, right? So A Limited are these guys here that had said they were going to use this building for how many years? 10 years. So now all of a sudden their workforce has doubled in size, and having doubled in size, we're told that they entered into a separate 8-year lease in the same building. So they have one floor, now they have another floor, right? Now, think about their 10-year lease. Do you think they will renew that 10-year lease at some point? do they now have an economic incentive for renewing this lease? Yes. They now use 2 floors in this entire building. So they'll want to be in this building for longer. Make sense? So moving all their stuff has now created an economic incentive, and at the end of the non-cancelable 10-year period, so now they want to continue this lease, and initially we were told that they had an option to extend for another what? 5 years. Okay, so now that they're going to extend for an additional 5 years, they will now have to reassess that liability. Initially, this liability was simple, 50,000, 9 years, present value 5%. Guys comfortable with that? That was our liability. Because we're going to use this building for 10 years. Now we're going to use the building for how many years? 15 years. There's an economic incentive for us to use the building for 15 years. So, what is now going to happen? What is now going to happen if ever there is a change in the lease term? If ever there is a change in the lease term, then we're going to reassess your liability by present valuing your changed payments and using a different discount rate. Okay, we're going to use a different discount rate, and this we get from paragraph paragraph 40 of your standard. And here we go. Looking at the example continued, A Limited's incremental borrowing rate at the end of the year when they did this reassessment is now sitting at 6%. So if it's now sitting at 6%, what you need to do is recalculate that liability, right? And how do you recalculate the liability? They were 5 years into the contract, so they'll present value the 5 years. 50,000 Rand, and they'll present value the additional period at 55,000 Rand. All right, so once you've done that calculation, you will see that the liability increases from 186,000 to 378,000 Rand because they've changed their estimate. Having changed their estimate, the journal entry therefore will be debit the right of use asset and will be credit the lease liability. Okay, so your lease liability is going to be reassessed anytime there is a lease term change, or anytime there is an assessment of your purchase option now being exercised or not being exercised, or if there are any future variable payments that will become payable in that period. Okay, and that's what you're going to do with your reassessment. You're going to adjust your liability. Right, I can see I've lost everyone in this room, but it's all good, guys. I did do a lot of theory today. In the next class, it's going to be question, 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 and I'll do a lot of questions around this. Because what I wanted to do is for you guys to see the standard from my perspective. There's an objective, right? You guys saw the objective of the standard. After looking at the objective, there was the scope, right? And then there was the recognition exemption, and then we went into identifying a lease, and then now we've measured the lease initially, subsequently, and we have now re-measured the lease. So in the next class, what I'll do is I'll go through a number of questions where I'm just looking at those components. All right, and then this set of notes I will try and upload by Friday, because all I'm now doing is just referencing that to the standard itself. Cool. All right, I will see you guys, I think, next Tuesday. Cool. Thank you, guys.